What if I told you there's a stock trading for pocket change right now, around 34 cents, that Wall Street analysts are slapping a $3 price target on? That's not a typo. That's an implied 800% upside on a chart that looks completely broken. Today we're breaking down a massive short squeeze setup hiding inside Datavault AI, ticker DVLT, and explaining exactly why this stock might be one of the most asymmetric turnaround plays on the market right now. If you take a quick glance at this company today, it looks like a classic retail-driven disaster, bleeding out week after week, heavily diluted, seemingly hanging on by a thread. The obvious conclusion: the story is over. But what if I told you the obvious conclusion is completely wrong? While retail investors are panicking and smashing the sell button, Wall Street analysts are aggressively maintaining that massive $3 price target. That is an implied 800% upside hiding underneath a chart that looks completely broken. At first glance, this looks like a straightforward dilution death spiral, but one specific hidden catalyst makes that conclusion much harder to defend. If you find this kind of deep analysis valuable, take a second to hit that like button and subscribe so you never miss one of these breakdowns. Now let's get into it. That sounds incredibly optimistic until you look at what's actually happening underneath the surface. Right now, we are witnessing a massive disconnect between Datavault's current market reality and its underlying potential. The stock is trapped in a range-bound downward bleed, largely because the market is suffering from severe PR exhaustion. Investors are tired of flashy headlines. They are demanding recognized, audited revenue. But while the retail crowd walks away, they are leaving behind a massive coiled spring. We are looking at a hidden setup where over 96.4 million shares are currently shorted. Pair that massive short interest with an incoming wave of multi-billion-dollar structured financing and massive third-quarter revenue jumps, and you have the exact ingredients required for a violent market reversal. But to understand where we are going, we first have to understand why the stock has been so weak. And that brings us to a crucial technical breakdown that caught a lot of traders off guard last week. In my mid-July coverage, I warned that this stock was highly volatile and heavily resisted. I gave an immediate, realistic technical target of a bounce to test the 50-day moving average, right around 43 cents. That bounce completely failed to materialize. Between July 23rd and July 31st, the stock barely tapped 38 cents before losing all momentum and bleeding down to close at a dismal 34 cents. For anyone watching the tape, the price action was incredibly frustrating. The stock just kept slowly fading, day after day, regardless of what the broader market was doing. Here's where the story starts to get more complicated, because that failure wasn't just random bad luck. That downward bleed occurred for a very specific, mathematical reason. The stock is currently trapped below both its 50-day and 200-day moving averages following a vicious death cross. On top of that technical trap, you have sheer mathematical exhaustion. Datavault has a bloated float of over 535 million shares. When you combine that massive supply of shares with aggressive selling pressure from major institutions and insiders offloading their positions, it creates a ceiling that is incredibly difficult to break through. The market sentiment is broken, and PR headlines alone are no longer enough to move the needle. So if the technicals are this ugly, why on earth would Wall Street still be screaming buy? But before you get too bearish and write the company off entirely, there's another layer to this analysis. While the retail market is hyper-focused on arguing over whether the floor is 30 cents or 25 cents, Wall Street is looking at a completely different time horizon. Maxim Group continues to maintain a firm buy rating with a price target of $3 per share. Let that sink in for a moment. From the current price levels of around 34 cents, hitting that target represents an explosive upside potential of 780 to 820%. Analysts don't hand out 800% upside targets based on meme coins or PR fluff. They do it because their forward-looking models are pricing in institutional-grade revenue that the broader market hasn't realized yet. What could possibly justify that kind of target on a stock trading for pennies? And if that revenue actually hits the books, it's going to trigger a market mechanic that short sellers are absolutely terrified of. Let's talk about the short squeeze potential, because the anatomy of this setup is undeniably powerful. As of mid-July, there were over 96.4 million shares sold short, making up over 12% of the public float. But the most important metric here is the days to cover ratio, which is sitting dangerously high at 3.9 to 5.4 days. What does that mean in plain English? It means that if every single short seller decided to buy back their shares to exit their positions based on average trading volume, it would take them up to 5 full days of non-stop buying to get out. That is a massive wall of forced buyers just waiting on the sidelines. Can you imagine what 5 consecutive days of forced buying pressure would do to a 34-cent stock? But a high short interest doesn't mean anything without a match to light the powder keg. This is the engine of a short squeeze. You already have the fuel, which is a deeply depressed stock price, combined with a high days-to-cover ratio. What the stock desperately needs right now is the spark. That spark has to be an undeniable, GAAP-audited revenue jump, or a major earnings surprise that fundamentally shifts the valuation. If Datavault AI can deliver that spark, it triggers the explosion. That massive wall of short sellers will be forced to buy simultaneously to cover their underwater positions. Given how cheap the stock is, that forced buying pressure could easily ignite the violent upward momentum retail investors have been patiently waiting for. But what are the actual chances of a company trading at 34 cents delivering a game-changing earnings surprise? What if they pull it off and the shorts have nowhere to hide? So the obvious question is, where is that spark going to come from? Let's look at what management was doing in the background last week. Since my last update on July 23rd, Datavault has quietly released a flurry of foundational building blocks. On July 24th, they appointed a new chief technology officer for their acoustic sciences division, signaling real progress towards spinning that division out into its own standalone, dividend-yielding public company. On July 27th, they aggressively expanded their sports presence, signing baseball legends Doc Gooden and Darryl Strawberry to their NIL vault. 2 days later, they expanded a massive healthcare tokenization licensing agreement. And most importantly, on July 31st, they officially set the date for their second quarter earnings call, August 19th. That date is circled on my calendar, and it should be circled on yours too. But PR announcements are just the appetizer. The real main course is what they are building on an institutional scale. This is where we find the foundation for that $3 Wall Street target. Datavault is finalizing its merger with NYIX, which is projected to trigger a massive $45 million revenue jump right in the third quarter. They are also acquiring CyberCatch to integrate quantum-resistant cybersecurity directly into their infrastructure. But the crown jewel is Project Questral. Datavault is deploying 48,000 GPUs across 100 U.S. cities to build an edge AI network, targeting a staggering $1 billion tokenized value. Phase 1 of this massive deployment is slated to be completed this quarter. How often do you see a penny stock deploying 48,000 GPUs across 100 cities? What happens to the share price if even a fraction of that tokenized value hits the books? And if you're wondering how a penny stock is going to pay for a billion-dollar AI network, they have already secured the capital pipeline. Datavault recently signed a $2 billion structured financing term sheet with Helmex, granting them exclusive global tokenization mandates. Because of these institutional-grade deals, management has confidently stepped up to the microphone and reiterated their ultimate target, a full-year 2026 revenue goal of $200 million. To put that in perspective, hitting that target would represent a nearly 400% year-over-year growth rate. That is hyper-growth territory, entirely disconnected from the current 34-cent share price. But if they have so much money coming in, why did they just take out a toxic loan? Let's address the elephant in the room. Recently, Datavault took out a bridge loan with incredibly harsh terms, steep discounts, and high penalty interest rates. At first glance, to the retail market, this looks terrifying. It looks like a company in severe financial distress gasping for short-term liquidity. But if we step back and recontextualize it, it might actually be a highly savvy survival tactic. Taking this bridge loan provided the immediate cash runway needed to cover merger expenses without having to dump millions of new shares onto the open market. By eating the cost of a bad loan, management actively prevented massive retail dilution, protecting the share structure just long enough to close the lucrative NYX merger and unlock that $45 million revenue jump. Would you rather take a bad loan or watch your shareholders get diluted into oblivion right before the biggest catalyst in your company's history? So with all of this extreme volatility and massive upside potential, how should you actually manage your money in this play? If you are a short-term trader, Datavault is currently a textbook candidate for range-bound swing trading. The chart has established a very clear line-in-the-sand support zone between 25 cents and 30 cents. For active traders, the strategy is simple. You look to accumulate during peak fear when the stock tests this low 30 support level, and you play the high volatility for a technical bounce. Your target for taking profits is the heavy resistance sitting at the 50-day moving average, somewhere between 42 and 46 cents. You buy the floor, sell the ceiling, and repeat. But if you are an investor looking for that 800% upside, your strategy looks entirely different. For investors with a longer time horizon, current price levels shouldn't be a source of panic. They offer a strategic accumulation phase. If you believe the underlying thesis, this is a strong buy turnaround play. You accumulate shares while they are deeply depressed in the low 30-cent range, and you hold through the volatility. You are waiting for the second-half revenue surge, the closure of the NYIX merger, and the execution of their $800 million tokenization pipeline. You aren't trading for pennies. You are holding for the realization of Wall Street's $3 price target. Which brings us to the final, undeniable equation driving this entire thesis. When you strip away the market noise, the emotion, and the daily ticker watching, you are left with a very simple equation. You have a deeply depressed entry price layered on top of a highly explosive 12% short float acting as a coiled spring, combined with a very real, management-backed $200 million revenue target. When you add those three elements together, you don't have a dying penny stock. You have the ultimate asymmetric turnaround play, and the moment of truth for this equation is coming up very, very quickly. Datavault AI is currently an undervalued asset masking a massive institutional revenue pipeline. High short interest has created a primed environment for a violent squeeze, but they must deliver the revenue to ignite it. Keep your eyes locked on the calendar. August 19th, 2026 is their second quarter earnings call. This is their make-or-break moment to prove to the market that their PR headlines are finally translating into recognized cash. Immediately following that, we are watching for the NYIX merger close and the completion of Project Questrel Phase 1 in the third quarter. The pieces are in place. The trap is set for short sellers. Now, management just has to execute. Before I wrap up, I need to be completely transparent with you. Nothing in this video constitutes financial advice. I am not a licensed financial advisor, and this content is for educational and entertainment purposes only. Every investment carries risk, especially in volatile, low-price securities like this one. You could lose some or all of your capital. Always do your own due diligence, consult with a qualified financial professional, and never invest money you cannot afford to lose. With that said, here's the bottom line. DVLT is sitting at one of the most compelling risk-reward setups I've covered in a long time. The short interest is massive, the catalysts are dated and approaching fast, and Wall Street's price target suggests the market is drastically mispricing this company. Whether you're a swing trader playing the range or a long-term investor accumulating for the turnaround, this is a name that deserves to be on your watch list heading into August 19th. Now I want to hear from you. Drop a comment below and tell me, do you think Datavault Management can actually deliver audited revenue on August 19th, or is this another case of all promise and no proof? I read every single comment, and I want to know where you stand. If you got value from this breakdown, smash that like button and subscribe to the channel so you're here when I cover the earnings call live. I'll see you in the next one.